on average, stock markets return about 7.5% per annum. And so if you're going to build wealth, then you need to, or you want to invest, then unless you want to do it actively, then the most sensible solution is to put in a little bit of money over a very long period of time. So I'll give you some numbers to show what I mean. If you invest £100 a month and put it into an ISA so you don't pay any tax on that, and you do that once a month for 40 years, so that's £1,200 a year, based on historical returns, at the end of that 40 years, you'll have somewhere between 285 and £300,000, possibly even more, depends on the stock market. So that's £100 a month. Doesn't sound, unachievable. And it doesn't need to be any more complex than that. So if you're putting, and stock markets go up and down. So if you put money into the stock market, most people are always worried about losing money because they want it to go, they want it to go up forever, but that's just not how these things work. But if you put in money every single month, and if the stock market drops, what that means is you're getting to buy it a little bit cheaper the next month. And so essentially, you're looking at a process over 30, 40 years. And so what happens on a month-on-month basis isn't really that relevant to you. Yes, if it drops a bit, you get to buy a bit more. And if it drops a bit more, you get to buy a bit more the next month. And then it goes back up again. In general, stock markets go up for 9 months of each year, and they go down for 3 months of each year. And that's just really a factor of the way these things move. So that would be my approach to making it as simple and stress-free as possible, is put a little bit of money away each month if you can afford it. And if you can't, because you've got kids or you've got other expenses, then stop it for a few months or a few years and then just keep putting it back in again. The one thing that's important is the earlier you start with this, the better it is. So if you can put some money in when you're young, in your 20s, and just leave it alone, it will compound and grow over time. So what I mean by investing in the stock market is investing in the whole stock market as opposed to individual stocks and shares. So if you look at the stock market we most popularly follow in the UK, which is the FTSE 100, that's the 100 biggest stocks in the UK. And so I can buy an individual stock in the UK, maybe Glaxo, or I can buy Tesla, for example. I can buy an individual stock, but individual stocks go up and down quite a lot. And so an individual stock can itself lose 100% of its value. There are companies that go bankrupt all the time. So if you're looking to build wealth over time, then you don't need to pick the hot stock of the moment. What you're looking to do is buy into long-term growth. And the way you do that is by buying something that tracks the whole index. So I'm buying the whole FTSE. You can think of it as in terms of I'm buying a little bit of every single one of those 100 stocks, or you can just say I'm buying the index. Essentially what it means is as long as the index keeps going up, I'm going to keep making money, and I don't need to worry about any individual stock within it losing money, going bankrupt or wherever, because I've got all of them. And in fact, what's interesting about this process is that in general, the index growth is usually dependent on a small handful of stocks. So maybe there are 5 stocks that do really, really well in an index in the FTSE in any particular year. And so if you're not invested in those 5 stocks, or you're invested in the 5 stocks that crash out of the index every year, you're going to really struggle. So just buy the index, and then you've got all of the ones that are going to do really, really well. The ones that don't do so well get removed from the index either the same year or the next year. So that's the easiest way to make sure that you're buying into the long-term growth of the index. And you don't even have to pick the FTSE. You can pick any index. You can pick the US market, or you can pick a global index. So you can buy something that tracks global stock markets. And that way you don't even have to pick the right country. Just go, as long as stock markets go up globally, I'm going to be making money. I'm not saying, and don't invest in things that are volatile. So I'm not anti-crypto. What I'm saying is that if you want to invest in single stocks, if you want to invest in in crypto, if you want to invest in volatile asset classes, make sure you only do it for a small part of your money. Don't take all your money and put it into something that can lose 50% in a week. And crypto can do that, and so can volatile stocks. They might go up and they might go down, and that's okay. Just remember that that is not the safest and simplest way to build wealth is over a long period of time. But if you really want to go and put some money into crypto or Tesla or whatever, and you love the story, absolutely. Just don't borrow money to fund that, and don't put all of your money into it. One way to look at this is understand the business model of the organization that's providing the information to you. So if you're looking for very conflict-free advice, then the Money and Pension Service, Martin Lewis, back to Martin Lewis, they just provide information, good information. They're not sponsored by anyone. They're not driven by anything other than trying to provide the right information. If you're looking at scams, and there are plenty of scams out there, be by doing a little bit of research and by understanding this concept of the base rate. The base rate for stock markets investments is about 7.5% per annum. 7.5 to 8% per annum is what you can expect to get if you invest in the stock market. So what it's telling you is that if someone's offering you 20 or 30% and telling you it's safe, then they're lying. And essentially that is a scam. So high returns always means high risk, but high risk doesn't mean high returns. So scams in general, scammers in general, work on the twin principles of persuasion of fear and greed. They make you really fearful that you're going to miss out, or they make you really fearful that you're in trouble. They make you really fearful that you need to move your money somewhere safe or whatever. And they operate on fear, or they try and offer you something that appears to be so good, you'd be a fool not to take it. Understand your base rate. Try not to get triggered by the sense of full scarcity or the fear or greed or whatever, and the manipulation that person is trying to exercise over you. Understand the concept of social proof and all the different types of persuasion that people use to persuade you to buy things, and then know what your base rate is and go, okay, does that make sense for me?